If you were thinking about refinancing your mortgage, make sure you listen up because there are new refinancing fees coming that you do not want to pay, so make sure you watch this video until the end. What's up everybody, I am Jasprit Singh from theminoritymindset.com and welcome to The Minority Mindset. Refinancing can be a great way to save money on your mortgage if you do it the right way and if you don't get slammed with fees. In August 2020, the Federal Housing Finance Agency announced that they're going to be tacking on a new 0.5% fee on lenders on all mortgage refinances that happen through Fannie Mae and Freddie Mac if you refinanced after September 1st. Naturally, people were angry and some executives called it a money grab and other financial executives said it was a tax because it was going to make refinancing more expensive for homeowners who just want to save some money. Surprisingly, the Federal Housing Finance Agency heard that and they backed off. They said, okay, we're not going to tack on this new 0.5% fee yet. And then they changed the start date from September 1st to December 1st, 2020. In simple terms, what that means is if you refinance your home after December 1st, 2020, your lender might have to pay an additional 0.5% fee, which means refinancing a home might become more expensive for you. Now, for most people, refinancing is still going to be the smart move even if you have to pay this additional fee, but if you don't have to pay an additional couple grand, why do it? Before I get into what you should do to save money on your refinance, I need you to do me a favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube will be much less likely to show you and other people our financial news and education videos. I got my new handy dandy whiteboard, so let's go over what happens when you refinance your home. Let's say you bought this home right here in 2010 and it cost you at the time $200,000. So when you go to get a loan, you got to put some money down. So let's say you put 20% down, which is $40,000. That means you took out a loan of $160,000. 2010 interest rates might have been something like 4.8% on your mortgage. And if you got a $160,000 loan at 4.8%, that means you're going to be paying, let me get my red marker for this one. You're going to be paying $840 a month for your $200,000 home because you got a $160,000 mortgage. Now, between 2010 and 2020, you're paying $840 a month every month on your mortgage. And then in 2020, a few things happen. You get hit with this pandemic and your property value goes up from $200,000, let me get my blue marker actually, to $300,000 because home values have gone up over the last decade. And at the same time, interest rates also go down from 4.8% to 3%. I changed the color of the arrow to make it more consistent, but at this point, your bank is hounding you on the phone saying, hey, you need to come and refinance your mortgage because you can save a ton of money. Now, there are ways for you to save a ton of money by refinancing your mortgage, but the reason why your bank is hounding you is because they don't want you to shop around and find a lower rate somewhere else. I'll be talking about that in just a minute. And so they want to close the deal while they can. But back to this. So you've been paying your mortgage for 10 years, and now the money you owe isn't $160,000. This has come down to $129,000 because you've been paying off some of your mortgage each and every month. But take a look at this. Before, you only had $40,000 worth of equity in your home. Now, you have $129,000 worth of loans on a $300,000 home, which means now you have equity of, let me do the math, $171,000 on your home. Quite a big jump from $40,000 back in 2010. Now with interest rates at 3%, you want to know what your options are for refinancing and you want to know how much money you can save. When you refinance your home, here's what happens. When you bought this home back in 2010, you got money from lender one. They gave you money and then you are paying lender one your monthly $840. When you refinance your home, you are going to lender two. And lender two is going to now give you money, and at the exact same time as they give you money, you are going to pay off lender one. So now lender one goes away, and now you're going to start paying lender two instead of lender one because lender two is letting you borrow money cheaper than lender one. At the time when we're recording this video, there are essentially 3 different ways that you can refinance your mortgage. I'm going to go through each one. That way you can see how you can save money using each different approach. So take a look at this. I'm going to clean this off. That way we can go over the 3 different ways that you can refinance your loan. Option 1 is you take out a brand new loan for $129,000 because remember, you took out a $160,000 loan and now in 2020 you only owe $129,000. So you take out a brand new $129,000 loan at 3% interest, and now your monthly payment is going to drop from $840 a month to $545 a month. So you're saving a few $100s each and every month, but now you're going to be on the hook for this new loan for 30 years. Option 2 is you still take out only $129,000. So this is just enough for you to pay off lender 1, and now you're going to start paying lender 2. You're going to take out this $129,000 at 3% interest, and now lender 2 is going to say, okay, pay us $545 a month. But this time you're going to say, okay, I'll pay you $545 a month plus some extra. Instead of paying $545, now you're going to pay $840 a month, even though your minimum payment is $545, which is the same amount of money as you were paying before. Now with option 2, you're not saving any money monthly because you're paying the same amount of money as you did before you refinanced. But if you follow this plan, you are going to be mortgage free in 16 years. So you are going to be mortgage free in the year 2036. If you just continued following this plan, you would be mortgage free in 30 years, which is 2040. So you're going to be mortgage free 4 years sooner than if you didn't refinance. And if you go down this plan, you're going to be mortgage free in 2050. So if you go down option 2, you're going to be mortgage free years sooner than option 1 and option 2, which means that's years of saving $840 a month. That's tens of thousands of dollars of savings by not having to pay mortgages for years. Option 3 is a little bit different. So now you have this home that you bought for $200,000 that is now worth $300,000, and you only owe $129,000. So this is how much you owe, and this is fair market value. So you have this $300,000 home that you only owe $129,000 on, and now option 3 you say, why don't I take out 80% of how much this home is worth? So now in option 3 you're going to take out $240,000. When you get this $240,000, you're going to pay off lender 1, so you're going to give them the $129,000 that you owe, and then you're going to have an additional $111,000 in your pocket. Now in option 3, your minimum payment is going to jump up from $840 a month to $1,010 a month, and you're going to have to continue making this payment for the next 30 years. So that will be until 2050. But now you have an extra $111,000 that you can use today. If you plan on using option 3 because you want to go on a nice vacation, you want to go shopping, or maybe you want to buy a brand new car, then you, my friend, are on a straight line path to, let me show you, broke. This option 3 right here should only be used if you have a good use for your money. And when I say good use for your money, I mean like an investment opportunity or a business opportunity where you can almost certainly guarantee that you're going to get at least a 3% return on your money. Because if you can do that, then the money you're going to make from your investment or your business is going to make you enough money to pay off the interest on this loan and put some more money in your pocket. If you don't have an opportunity like that, stay away from option 3. This option comes with the most risk. The reason your bank has been hounding you to do one of these 3 refinance options is because some lenders charge lower interest rates than others, and if your bank can lock you in, then you don't have the opportunity to shop around. The simplest thing that you can do to save money, save time, and shop around to find great rates is by using a mortgage comparison tool. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage and refinance rates at no cost to you because they have multiple lenders competing for your business on their marketplace. So you can compare great rates and pick the best loan option that's best for you. It's simple. You just got to go onto their website and enter in a few pieces of information, which just takes a few minutes, and the Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Credible's pre-qualification process is easy to use, and checking the pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage rates you might qualify for, I got the link to where you can do that with Credible in the description below. Credible does pay Minority Mindset an advertising fee when you submit a pre-qualification request, but there's no additional cost to you. Credible Operations Inc. NMLS number 1681276 is not available in all states, so if you want to learn more, I got the link to where you can do that in the description below. The way this new refinance fee or tax works that I talked about in the beginning of this video is that the Federal Housing Finance Agency will charge all lenders a one-time 0.5% fee if your refinance loan is backed by Fannie Mae or Freddie Mac. Let me show you what's going on, that way you can better understand how to avoid paying any unnecessary fees. So let's say lender A gives you a $100,000 loan. So this money is going out, and then Bunty goes to lender A, and Bunty says, okay, I want $100,000 too. So now another $100,000 goes out from lender A, and then Nancy goes to lender A, and she says, you know, I want $100,000 loan too. So now $100,000 goes from lender A to Nancy. So lender A has all this money going out. They have money going to you, Bunty, and Nancy. And if lender A has to wait for you, Bunty, and Nancy to make the monthly payments on your loans before they have more money to issue new loans, eventually lender A is going to run out of money because they have way more money going out than they have money coming back in, because they're going to give you $100,000 today and they have to wait 30 years to get their money back. That's where Fannie Mae and Freddie Mac will come into play, because they will buy these loans from lender A. That way lender A has money to issue more loans. So lender A is going to give you all this money, and then Fannie Mae and Freddie Mac are going to come to lender A and say, okay, we will give you money, you give us these paper loans. You can't go directly to Fannie Mae and Freddie Mac and borrow money. You got to go to this lender, but the lender is going to get money from Fannie Mae and Freddie Mac. That way they can continue to make more loans. What's going to happen starting December 1st, 2020, unless it gets pushed again, but what's scheduled to happen on December 1st is if you get a refinance loan through lender A is going to give this loan to Fannie Mae and Freddie Mac in exchange for money. But then starting December 1st, Fannie Mae and Freddie Mac are going to start charging your lender an additional one-time 0.5% fee. That means if your bank is giving you a loan, they're going to have to pay this additional fee to Fannie Mae and Freddie Mac in order to sell their loan to them. That way they can issue more loans. You might think, wow, that sucks for lender A because now they have to pay this additional fee to do this refinancing. But you have to understand, this lender A has to keep a certain amount of margin or profit to stay in business, which means if lender A has to pay an additional fee, there's a very good chance that this fee is going to get moved along here. That way you have to pay an additional fee to refinance because lender A has higher costs. Now, I don't know this for sure yet, but there's a very good chance that some lenders are going to eat up this entire cost to maintain their business, and other lenders are going to push this entire cost to you, while some lenders are going to be a hybrid. They're going to eat up some of the cost and make you pay the additional fee, which is why it's so important to use a mortgage comparison tool, especially if you plan on refinancing after December 1st, because you want to know how much you're going to have to pay in fees in order to refinance your mortgage. To put it in perspective, if you're refinancing $200,000, that means your lender is going to have to pay an additional 0.5% fee on $2,000, which is a one-time $1,000 fee, which you might have to eat up a portion of. So this fee isn't really a deal breaker when it comes to refinancing, but why pay this additional fee if you don't have to? That's why if you are interested in refinancing your mortgage, it's better to do it sooner rather than later, because if you can refinance your mortgage before December 1st, you can avoid paying this fee altogether. And you also want to, again, make sure you're shopping it around. That way you can make sure you're getting the best deal possible and paying the lowest fees possible. But before you do anything, you want to make sure you understand what your goal is with your refinance. So remember those 3 options that I gave you earlier. That way you can make sure you're doing something that's going to help your financial situation. Thank you for watching. If you enjoyed this video, share it with one friend, that way we can help spread the word. If you want to understand what's really going on with interest rates and why they've been crashing so much, I already made a video on this, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.